All right. All right, so I think we got recording, and hopefully, I know one lady wanted to go and, you went in. You look different now. What did you do? Change your hair as well? What is it? What's going on over here? All right, people. All right. We're recording everything, and we continue on with the discussion. So when we break for for coffee, what we had done was discussed the role of global wealth management, and we started talking about the investor. So we started understanding what is the investor looking for. We looked at risk and return. That is what we call investment objectives. It's very important that you understand that return as well as risk together are investment objectives. All right? Why is this investment objective? Because you're saying, I want to get this return given my risk capacity, given that what I want to take on as risk. And now we come to the bits which are constraints, which says what we cannot do, what is required. So I have a couple of constraints over here. Liquidity and taxes are one of the major ones. As I mentioned, liquidity tells you how liquid assets you want in your portfolio. And what that means is that it's a definition by saying how soon you want a portion of your assets, portion of your portfolio to be sold off. So it's a definition of what kind of what proportion of liquid assets you need. Taxes, of course, we understand that they have to be minimized. We also understand that these investors are the highest tax bracket. So what we want to know is how to restructure their portfolios so that the capital gains are not really exposed to taxes. Their income is not exposed to taxes. Once we enter ideas which will prolong the investment horizon, such as trust and bequest, these assets, these endowments, these portfolios need to be structured for longer periods of time. And that will bring in a constraint as to how quickly you can eat into your portfolio. I'm not going to talk about the other aspects, but one of the aspects that I may want to bring about is outside assets later on in this course today. What we mean by that is assets that are not available in the local market or not available as listed assets. So we are going to look at those investments later on today. So what do we want to do in terms of our portfolio construction? We want to understand what we can invest in, what is allowed to be invested, the universe of investment. So we start off with almost no restrictions other than what is defined by the investor. So universe of securities, and for each class of assets, you have to define a benchmark. Ladies and gentlemen, I have to explain what a benchmark is. I know you discussed benchmark with Ralf in the first session. The idea of benchmark is an investment that has to have two characteristics. One, it has to cover the exposure or the asset group that you're looking for. That's number one. Number two, it has to be a naive investment. It has to be a simple investment. And by simple, we mean that it has to be based upon no mispricing. So it has to go attached with the idea that we're not trying to take advantage of markets being inefficient, some assets being undervalued, some assets being overvalued, invest more in undervalued assets, invest less in overvalued assets. We are not going into that discussion. A naive investment is where you have no opinion whether an asset is overvalued or undervalued. You're only investing in it based on its characteristics. So if you think about most of the major indexes, and I'll take you through that after the break, most of the major indexes are looking at exactly this idea, exposure and simple investment. So these benchmarks will indicate what kind of universe we are identifying. Now, I'll give you a couple of names that you might think of from the Australian context. So have you heard of ASX 200? What is ASX 200? Go for it. Rudy, yeah?
Yep.
Yeah.
It's like listed consider ASX the most traded one, but under?
Not necessarily the most traded. I mean, that's an outcome that will happen, but it's the largest ones. So the largest by market capitalization. Interestingly enough, 200 doesn't remain 200 all the time. Sometimes it goes more than 200, sometimes it goes less than 200, but that's a different point altogether. What is ASX 100? Top 100. What's the difference between 100 and 200 in terms of exposure?
Exposure to the small cap.
Beautiful. So not just the top large 100, but also the smaller 100. So you have a wide exposure. Now, my question is that if I invest in if I consider the ASX 100 performance and ASX 200 performance, do you think it's going to be very different? What do you reckon? Which one do you think may be more or less volatile? I'm just giving, this is just questions. Which one will be more diversified? Let's start with that. 200 should be more diversified. Which one will be more volatile? But she just said 200 is more diversified. So why will it be more volatile?
Because it will be covering the small caps.
Sure. So now the question is, how is the weighting of the small caps compared to large caps? So when you start with 100 and you go on to the next 200, there will be, of course, decrease in the weights of some of the large ones and given to the small ones. What will happen is very small weights come off the large one, and those small weights go into the small ones. So the smaller ones get less weighting. Larger ones have higher weighting. So smaller ones have smaller influence, and larger ones have more influence. So keep that in mind, that it is the question, what are you trying to look at? What are you trying to invest in? Are you trying to invest in a more diversified portfolio? What is more diversified than ASX 200? Good. What's more diversified than ASX 300? Sorry? Oh, good. I was going to say, does anybody say ASX 400? Good. It's called, as you guys just pointed out, is All Ordinaries Index. And how many stocks do you have in All Ordinaries Index? Sorry? How many? Is there a number that's defined? Around 2,000. In fact, it's supposed to consider all of them except for the least liquid ones. So that's the idea. So what we are going to understand is the benchmarks, and I'm going to show you two benchmarks, equities and fixed income securities. These are the well-known benchmarks across the world, but that'll happen later. What can we not invest in? What could be the assets that a wealth, so we're not talking about institutions, we're not talking about small retail investors, we're talking about sophisticated investors. What kind of assets will a sophisticated investor not like to invest in? What would you say that, oh, I'm not going to invest in this. This is not for me. Would it be large caps? Would they say, no, I'm not going to invest in large cap equities? No, they probably wouldn't like to. Small caps? No, small caps have good growth potential. Could it be international markets? Maybe. Some markets, they might say, oh, look, I'm not going to be investing in those markets. For example, emerging markets is something that a lot of Western investors may be very careful to invest in because they believe that it might be more risky, however, come with higher growth. So we have to define what is not available. A lot of times they also talk about policies regarding derivatives. They'll say you cannot use certain derivatives, certain way of using derivatives. It's not that you cannot use derivatives. Derivatives have two usages. One usage we all know is to hedge risk, to lower risk. What's the other use of derivatives? There you go. To leverage up a speculation. That's what a derivative can do. So you can, for example, take a long future or a short future, thinking either the market is going to go up or the market is going to go down. That may be prohibited, and most often that is prohibited. So policy regarding derivatives, notice it's not saying do not use derivatives. What is the usage that is stipulated in these portfolios? And usually it is to minimize risk. And then we have to provide our risk and return expectations, target excess returns, and the measurement periods. And within risk, I put down a couple of them. Other than standard deviation, which would be normal, permissible tracking errors, and I'll talk about that, and maximum underperformance, the downside risk. So we're going to use these two ideas. So, ladies and gentlemen, just in your overheads, after the orange tab, I hope it's the orange tab, there's a bit called a roadmap for the roadmap. There's an article over here. Yes, that's right. Yes. So this is a document that I find provides you with an overview of how to create an investment policy statement. I really like this document. This is an example, and of course, over today, you'll see an actual document as well. But at the moment, this is just an example, and I've taken bits of it. So this is on page A3 of this. Sorry, A2. So if you go all through this article, you'll come to this bit which says sample investment policy statement. So this is after page 5. Yep. There you go. Yep. There you go. Yep. Perfect. Yes, miss. Perfect. Just further up, sir. Hang on. Here. Yeah. Perfect. Well done. Well done. Yes, miss. Good. Yes, perfect. So, I haven't gone through the earlier bits which talks about the roles and responsibilities in Part B and policy, Part A. I'm going directly to Part C, investment goals and objectives. So over here, it says that the goal of the investment objective for the endowment fund is to preserve and enhance the real purchasing power of these assets over time. Who can tell me in simple English, what does it mean? Enhance, so preserve and enhance, so two words. So what would that mean to you, sir? Preserve and enhance real purchasing power. Yes, miss? No, not liquidity per se.
So you're looking to obviously increase the capital of your investment?
In real terms. So, yes, that's right. Abid.
Vaibhav.
Vaibhav.
Vaibhav. V-A-I-B-H-A-V.
Vaibhav.
Yep, that's
all right, Vaibhav. Do you have a short nickname as well?
Just call me V.
V. I like that. That's a cool name now, V. So, real purchasing power, that means investment in real terms. All right? That means, as we just mentioned, take out the inflation effect and understand whether that your portfolio has to be preserved in real terms. We're not saying on a daily basis. There's no statement over here which says on a daily basis you have to maintain in real terms, but over time. And they usually stipulate what the time is, usually 3 to 5 years. Not just preserve, but also enhance, which means to grow as well in real terms. All right? While providing a reasonably predicted contribution to the annual operating budget. In this case, this endowment is to satisfy the operational needs of, or be part of the operational needs of some entity, and that means regular cash flows. So they say that after paying for this, you must, your first rule is, I need to preserve my capital in real terms. My second rule is, and I'm just going to show you because there are three aspects over here. Preserve, enhance, pay. When you pay, when you contribute, the value will fall because you actually take out assets from your portfolio and giving it to your to whoever you, university or hospital or whatever. So first rule, it has to be preserved. That means you cannot go down below over a period of time. Second, contribute. And third, enhance. And so we have to think 1, 2, 3. It cannot be 1, 2, and then 3. Sometimes you may even have to pay, even if your real value is decreasing, hoping or ensuring that over a longer period of time, you'll come back up to that level. Now, take a look at how the returns are calculated. Notice the words, okay? This is very important. The expected return objective for the portfolio measured over rolling 3 years and 5-year period is to provide an annualized total return net of fees of 5% over the inflation rates. 5% above CPI. That means I have to ensure that my portfolio will not only generate 5% plus the CPI. Now, if I can do that, I'll be able to perhaps do all three of them. Okay? Over 3 to 5 year period, rolling, how do you measure this? How will you measure 3 to 5 year rolling periods? Do you understand moving averages? This is the same idea, that you take a 3-year period and move it by a month, next 3-year period, move it by a month, next 3-year period, and so at any 3-year period or any 5-year period, my portfolio has to maintain minimum requirements, preserved in real terms, next, be able to contribute, and third, enhance value. Net of fees. Who are we paying? Or for what? Which managers? Managing, what are they managing? That's right, it's you guys. This fee is your fee. How do you think you charge fees, by the way? How would you like to charge fees? Sorry? Normally that's how it is. It's a percentage of assets. So it's about 1%, 1.5%, somewhere there. So it could be anywhere from 0.75 to 1.5% value of assets. Is that the only way fees is paid? Or is there other ways as well? With some kind of a bonus, some kind of an incentive. Can I ask this question to you people? Why do we need to give incentive to anyone?
Because they are providing us with extra returns. So
But you're giving them a salary. You just said 1% of their assets.
if they beat a certain level of...
But why? Why do you want to do that? Why would you want to spend it? They'll do it anyhow, right? Wouldn't you like to perform the best regardless whether you're getting incentive fee or not? You would? So incentive fee is useless for you, right?
It will like help me like, it will motivate me to like perform better. Even
Are
though
you saying you will not be motivated to perform well if you do not receive an incentive fee?
I will be, but
I'm just messing with you, V. It is obvious. This is how, when you have a conflict of interest. Okay, over here, where's the conflict? There's the investor and there's a manager. Investor is using the manager as his agent to invest. Investor is the principal, manager is the agent. What is the conflict over here? We call that the principal-agent conflict. What is the conflict over here? If you give V, because, sir, you started this argument, you are going to be the target of this discussion. Because we gave V the choice to, not the choice, the responsibility to invest, and we say, you're going to get 1% of the assets. Now, V can be, all right, I'm going to get 1% anyhow. I really don't have to work too hard. I can invest in just indexes. But then we say, if you beat the index by 2%, every percent you beat, we split the money half-half. Suddenly, V is more keen. It's like, all right, now I'll be more motivated. So you're absolutely right. I was just messing with you. Incentive fee encourages motivation and encourages the agent to work in line with principal's requirements. right? So the agent and the principal are now aligned. When there's no incentive fee, it could be that the principal wants something and the agent wants something else. So maybe the agent is investing in his friend's investments just because his friend is giving him some cut, perhaps. The investment committee has set an additional goal of outperforming all net investments, a composite market index which represents as follows. This market index that they have created is an outcome of their asset allocation. This index comes after the asset allocation has been constructed. So I'll just show you on the next page that the asset allocation is exactly that. Over here, we have a couple of indexes, and I want you to understand these indexes. The first one is a T-bill index. The second one is a bond index. Both of them are US. The third one is MSCI AC World. AC World. MSCI, have you people heard the term MSCI before, sir? Have you heard? Never. Never? No. You have heard of MSCI. Think about an investment bank that starts with M. Morgan Stanley. So this is Morgan Stanley index. AC World means all the market, the whole world, yeah? Keep in mind, it's just like any other index. Larger caps get higher weighting, smaller caps get smaller weighting. Larger countries get higher weighting, smaller countries get smaller weighting. So this will happen. Then you have, so if I look at this, which would be the most represented economies? US will be the largest one, given a weighting of about 45%. What else do you have? Japan. So this is by capitalization. It's very different. So at the moment, Chinese capitalization is not that high. So if we're just talking about it's actually the developed markets. So you'll have the US, UK, Japan, Germany, France, so on and so forth. So those will be the higher represented. So even though it says the whole world, the smaller economies like Indonesia or Vietnam or even China, smaller economies by capitalization, even Australia. What do you think Australia's weighting is going to be in the world? 2%. So if Australia is 2%, you can imagine the rest of the economies are even smaller. So if Australia gets a weighting of 2%, then you have a fund index with the term HFRI. HF? Hedge funds. This is hedge funds. This is a particular kind of a benchmark, and they create a hedge fund of fund index. You don't have to worry about what fund of fund is in this course, and AFM it'll be required. So this is a hedge fund index. What's the next one? Cambridge Associates Private Equity Composite. This is a private equity benchmark, and Cambridge Associates are a provider of this index. And the last one, what's that? NC Reef. This, you probably know this. No? No? Not non-commercial. I don't know what NC stands for, but there are two competing indices. One is NA REITs and one is NC Reef. And my understanding is NC Reef is a little more broader than NA REITs. So again, it's a real estate index for the US market, only for the US market. There's another term over here which says real assets. What does the term real asset mean? And what kind of assets are not real? What is a non-real asset? Or rather, what's a real asset? Generally, a real asset is something that can be touched. And like gold, like real estate, I can hold this wall and I say, this wall is mine. So I can hold a bar of gold, put it in my pocket, this gold. But a bond or an equity, or these are not real assets in that you do not own the whole asset. You own just part of the investment in that asset. And those assets are they eventually become real assets because you have plant, you have land, etc. So those are the indexes. I'll just show you the index. And keep in mind, notice this term, based on the asset allocation described in section E below. So when we go to section E, you'll see that. Risk. How is the risk measured? The endowment should experience risk as measured by volatility, not materially larger than the composite benchmark defined above. So all they're saying is risk has to be less than the risk of this benchmark. Whatever you create has to be less than that. Here is the asset allocation. What is important to us is this guy, which is called the target asset allocation. The target asset allocation is saying this is how much we invest in each of these assets. This is our long-term goal. This is not a goal that is going to be every day. Miss Coffee, are you feeling all right? It's a bit boring, no? So this is how much we're going to invest in each of these assets. This is our long-term goal. This is not our short-term goal. Now, Miss, just to wake you up, I'm going to ask you this question. So, Miss, what's your name? Hello. You're not going to sleep again, right?
No.
Oh, okay. What's your name?
Alice.
Alice. And what's your name?
Lee.
Lee. And so, Alice and Lee, you're going to help me out over here. It's okay. Don't be scared. It's going to be okay. Let me ask you this question. There are about 7 different assets described over here. What we're going to do is try to work out what each of these assets, how each of these assets contribute in this portfolio. Yeah? So, is there any advantage of keeping cash in your portfolio? Alice? Do you think cash is an important asset? What is the feature of cash? It's liquid, provides liquidity. Yeah? Is it important in a portfolio?
Yeah.
Why?
Because one, like if it's too risky on your debt, you can sell the debt and buy.
So you can reduce the risk by keeping cash. Good. Any other reason that you might have cash? Why?
Because one of the investment goal is to contribute and pay.
There you go. I need to provide cash. And this is a good way of having cash. Any other reason to have cash? I know it's now that we have got 2 answers, third one might be difficult. Any other reason to have cash?
So that they can manage transaction flow.
Could be for cash flows that are required from transactions. It can even be for future opportunities. Maybe, yeah? Is there any downside of having cash? Less growth. I mean, you get no return. In fact, you get less than inflation. So if your goal is to achieve returns higher than inflation, cash is bad. However, you just mentioned there's so many advantages of cash. So we have to be very careful how much cash we keep. Fixed income. What's the advantage of fixed income? Oh, no, not this group. Not this group. How about you, sir? What's the advantage of fixed income securities in a portfolio? Oh, you've done fixed income. Do you know what fixed income are? Bonds. Is it good to have bonds in a portfolio or not so good?
Maybe good.
Okay, why?
No idea.
How about you, sir? Have you done fixed income securities? Not yet. Not.
I haven't. I think it's good for the portfolio.
Because?
It don't have the high level of the risk.
Beautiful. One example is fixed income is good in your portfolio because it has lower levels of risk. Does everybody agree with this? I guess what the gentleman is saying is lower level of risk compared to equities. So it is lower than equities. But what is the advantage of fixed income securities in a portfolio? How about yourself, miss? Next to you.
It can support cash flow.
Mm-hmm. Beautiful. Remember, we asked why is cash important, and you said because we can get some cash flows. But here we can get cash flows as well. Perfect. What else? When do bonds do well? When interest rates rise or when interest rates fall? When yields go up, what happens to price of a bond? It goes down. And when yields go down, price of the bond goes up. When do yields go down? When the economy is doing well or when the economy is doing badly? Sorry? Poorly. Because when economies are doing poorly, the central banks try to stimulate the economy. Right? How do they try to stimulate the economy? They drop the interest rates. As interest rates drop, the yields in the market drop. And as yields in the market drop, prices rise. So bonds do well when economies are doing poorly. And how do equities do in that market? In poor economic conditions, equities do badly. Now here is fantastic news. I have one asset that is doing poorly, another asset that is doing well. And as V says, I get a really nice diversified portfolio. So bonds, sir, go back to yourself, sir. What's your name? Alice? No, that's her name.
Alex.
Alex. It'll be. I thought, yeah, I was thinking, how can two people have the same name, Alice, and one of them is a male? All right. So, Alex, now you know some other advantages of bonds. So now tell us, what's the advantage of bonds in your portfolio? What is the advantage of bonds in your portfolio? We just talked about it. All right. Miss, what's your name again?
Nicole.
Nicole. Alex doesn't remember why bonds are important. Tell him.
Like I just said, support the cash flow.
Good.
Because besides, it can serve like to diversify the portfolio.
Because bonds behave opposite to the economic conditions. When economic conditions go down, bonds do well. Alex, do you remember this now? Why should we have bonds in our portfolio? Miss, what's your name? Kashina. Kashina, tell us, why are bonds important in our portfolio? Good. It what? Diversify the portfolio. Wonderful. So we understand why we need bonds. What about equities? Why do we need equities in our portfolio? Everybody should know this answer. Sir, what's your name? Tristan.
Yeah.
And Miss, what's your name? Tia. And sir, what's your name?
Louis.
Louis and Tia, tell us, why are equities important in our portfolio? Sorry?
Compound returns.
Compounded returns, growth, yes. And?
Exactly the same function with the bond.
Except in markets growing. In fact, equities grow a lot more than bonds. There's a limit to how much bonds can grow because your yields can go down to zero. They cannot go negative. So there's a limit to how much your bonds can grow. But for equities, there's no limit. And so you have infinite growth possibly available with equities. You don't have that with bonds. The other thing is, there's another aspect which is very interesting in equities. You don't have any government equities. There's no such thing as government equities. But in bonds, you have both government and corporate bonds. You can get two sides of the equation over here. With government bonds, you get the risk-free aspect, which is just the yield. And with corporate, you also get some corporate risk in it. Is corporate risk bad? Not really. Corporate risk actually allows you to have more or higher returns. In equities, we also get that corporate risk. But we're not just getting the corporate risk of one corporation, we get the corporate risk of the sector and of the economy. So you're getting the exposure to the economy in two different ways. And it's very interesting that the income bond analysts who follow bonds and analysts who follow equities, they always talk to each other because one team's rise is the other team's loss, right? So keep that in mind. All right. What about these? Hybrid opportunistic, these are, hedge funds and private equity. What's the use of these two guys? Has Ralf talked about them at all in the first lecture? No? Not a lot. So what are these creatures, hedge funds and private equity? Sorry? Who can tell us? Luis? Do you know hedge funds, private equity? Did you watch Wolf of Wall Street? You didn't? No. That's such an amazing movie. I mean, okay, there's a lot of action in it as well. Well, you gotta watch. Did you watch Wall Street, the old one, with Michael Douglas and no Charlie Sheen and stuff? No, you must have watched it.
I haven't actually watched it, but I know. I've seen it before.
Okay, so look, this area is so interesting. If you thought funds management was interesting because there's a fund manager and they're investing in funds, hedge funds is 100 times more exciting. What these people are doing is they're buying assets that are undervalued and selling assets that are overvalued, that they don't even have. And they create this portfolio that has almost no risk. And they can create returns regardless what market conditions are. Markets up, you can get returns. Market down, you still get positive returns. And that's why these creatures, hedge funds, are so exciting. When you come to AFM, for those who will be studying advanced funds management, I'll go into a lot more detail on this. But they are very, very exciting opportunities. So those are hedge funds. And they play on any kind of asset in the market. It could be commodities, it could be interest rates, it could be currencies, it could be equities, it could be real estate, any asset that you can think of, the hedge funds can invest in them. And so the beauty of these investments are that they're extremely risky, illiquid, however, they provide high levels of growth in any market condition. So that's equities, hedge funds. Private equity. Okay, this is even more fun. This is where Wall Street comes in. So, not Wall Street, the place, but Wall Street, the movie. So in that, what happens is that in private equity, what happens is that suppose you see this large company such as Apple or Microsoft. It has to be a large publicly listed company. It's not doing too well. These private equity people, they go in and they leverage buy that firm, or at least a controlling share of that firm. And then they change or they cut, depending on what. For example, something similar happened with Qantas a little while ago. Qantas was not doing well. What happened? What changed in Qantas? Do you know Qantas? There's an airline, Australian, yeah? It was not doing too well. So 3-4 years ago, it was doing terribly. They were making losses. And then something changed. Yeah, John, do you remember anything that happened? What did they sell off? They made a couple of changes.
They were probably an airline, like the smaller airline companies they had, didn't they sell that off? They sold a bunch of their assets.
They sold off their loyalty cards, Qantas Club, Qantas frequent flyer points. So they're no longer controlled by Qantas. They sold that off. It's true. And they sold off, and they restricted their foreign flights. So international destinations, they came down, and they had joint venture with Emirates. So previously they had joint ventures with BA, and I think one American Airlines, if I'm not mistaken. But now they have a joint venture with Emirates, and apparently we had pretty decent results last year. I don't know how this year will pan out. My understanding is Qantas is not doing too well at the moment, but whoever is in the market. But the point is this, that to make those changes, you have to have the controlling share. And if you are allowing the board to do their work, it might not happen because board may not have had the ideas of how to restructure the firm. So a small team of managers comes in, they buy off the controlling share, and they can do a couple of things. They can chop off the firm, sell off parts of it, make the firm more focused, and then make it go public again. And that's the role of private equity. So private equity firms are small investment firms. So they'd be little shops. we call them investment shops. So there'll be little offices, glass wall, 4 people sitting, maybe the whole team is about 6 or 8 people, and they go in and buy a whole large publicly listed firm. Again, very exciting. So ladies and gentlemen, I want you to watch 2 movies tonight. Tonight. Well, you can't. You have access to internet, right? One is Wall Street and one is Wolf of Wall Street. You have to watch both of them. They're very exciting. And if you get a chance, there's another movie I want you guys to watch. It is not a dirty one. It's called Rogue Trader. It's for those people who are studying derivatives. This is Nick Leeson. This is the story of Nick Leeson, and on how he got what he did and how he got caught in Singapore is very exciting. So do watch these 3 movies if you get a chance. And because it's recorded, you can listen to it again. Hybrid opportunistic allocations, you'll take a look at later. These are different kinds of investments other than the traditional fixed income and equities. And real assets are real estate and some other metals such as gold. There are 2 aspects I want you to focus on. Take a look at liquidity. It says liquidity is required to meet operating cash needs. You guys all talked about it. We actually pointed it out as well. Rudy. But you can also have additional unanticipated needs. So for that, you need to keep assets, some assets, not all, that can be converted to cash very quickly. And they mention over here how quickly they need to be. So it says at least 2 years of anticipated operating cash needs plus an additional 2 years of expected net funding requirements for private investment should be kept in liquid assets. So notice the moment you say liquid assets, that has to be large caps, that has to be fixed income securities, that has to be cash, and real estate investment trusts. And those will allow you to have liquidity. And so they talk about exactly how the liquidity has to be managed. Notice this is a constraint that you're putting on your portfolio. And here is Alex. Sorry, Alex, I have to ask you again. And what's your name, sir? Sum. S-U-M.
S-O-N-G.
Oh, Song. Song. And everybody else, take a look at why each asset class is required in your portfolio. It provides you with information that makes you understand why. If an asset is not providing you with any benefit for your investment objective, it should not be here. So we are on, this is, ladies and gentlemen, this is like creating a team, a soccer team, that you'll only keep people who are valuable. I mean, could you keep a goalkeeper who just hangs out and doesn't stop any goals? Or a forward who doesn't want to run? So you only want to have aspects or assets that will help you in your portfolio to achieve your investment objective. Part of it is also restrictions on how this asset class will be implemented. So I just want to make sure that you understand 2 terms that we talk about. One is asset allocation. Asset allocation says define how much you plan to invest, how much you want to maintain your investment in every asset class. But that doesn't mean you have a portfolio as yet. You don't have an investment. This is just a plan. So to invest, you have to invest with some funds. And the next page tells you how you're going to invest in those funds. There are no manager-specified limits for cash, so you can have 1 fund manager or 10 fund managers for this. But take a look at fixed income securities. It says no more than 15% of the entire portfolio should be invested with a single fixed income manager. No more than 15% of the entire portfolio should be invested with a single equity manager. Why? Why? Why would you, 15%, no more than 15% with a single fund manager? How much are we investing in fixed income securities? Target is 10, right? Maximum is 25. So if we are ever going to go with the maximum, we need at least 2 fund managers. And if you think about target for equities, it's already 35. That implies at least 3 fund managers. Once we go to 50, that means about 4 fund managers. Why do we need so many fund managers? Why can't we have 1 fund manager?
They can manage different sectors.
Okay, that could be one example. One is managing corporate bonds, the other one is managing government bonds. Good. Why else?
Diversification.
Of what?
What the managers.
Of managers. This is the answer. You're not diversifying the portfolio because that's already diversified. Look, you have so many different assets. You already diversified your portfolio. But within each asset, we are diversifying even further. Now what are we diversifying? We're diversifying fund manager risk. How the fund manager manages his investments. So if I give all the money to John to invest in equities and all the money to Alex to invest in fixed income securities, what if John is a terrible fund manager? I put in maybe 40% of my equities with John, and John is a terrible fund manager. This is something that you guys will understand. There's an advantage of investing in one fund manager. What's the advantage? If I give him more money to invest, what is he going to give me in return? Have you bought Coke? Sorry. Do you guys, anybody buys Coke or cold drink? Oh, you buy. What's your name, sir? Louis. Louis and Louis. Louis. So Louis doesn't just buy Coke, he also buys Red Bull. Yeah? Louis, how much did that can of Coke cost? Where did you get that from? Really? Crap. I always buy for $2. Okay. Have you bought this ever in Coles or Woolies? Have you bought Coke in Coles and Woolies? No? Have you bought this big carton of 30? Has anybody bought those big cartons of Coke? How much do they cost per can?
Per can.
Yeah.
I think it's about 70 cents a can.
70 cents. What's the advantage of investing large amounts of investment with one fund manager? I can reduce my cost. John could say that, look, for everybody else, I'll charge 1%. But if you give me more money to invest, I'll give you 80.8%. I get a 0.2% discount. And that is the advantage of investing in one fund manager. What's the disadvantage? You guys all realize this. If John is a terrible fund manager, all my money has gone down the drain with him. Right? So, so what we have to understand is the advantages versus disadvantages of investing in one fund manager. Okay. Then I'll talk about performance measures, and remember we have several performance measures. I'll come back to this after the break once we get into the implementation part. All right, so this is where I'm going to stop for a little while. Ladies and gentlemen, I thought that for this class, I'm going to show you some data exercises. And given that, what's your name?
Joanne.
Joanne. Joanne just got herself a laptop. Did you?
No.
But you said you were going to go home and get a laptop. Change clothes, not laptop. All right. So I thought that's what we were going to do. Anyhow. What I've got over here is, let's just make it larger for you guys. I've got certain sectors and benchmarks that I got for only the Australian market, all right? So over here I've got some US markets, but over here I've got only the Australian market. So I'll just show you what I've got. I've got the bank bills, so I'll just put that down. So bank bill index. This is a corporate bond index. This is a government bond index. I have the S&P 200. And I have A-REITs. A-REITs stands for Australian REITs. Does everybody know what REIT stands for? Real Estate Investment Trust. All right. I've got some others over there. I'm just going to delete them for a little while because I don't need them. So I've got 1, 2, 3, 4, 5 assets over here. So the first thing we're going to do is just take a period where all the assets are available. So we'll start with 2005. And for each one of them, the first thing we're going to do is work out their returns. To work out returns, I think you've all learned this in previous courses, we use a log normal way of calculating returns. That way is considered to be the best way because it allows for two things: the data to become normally distributed or close to normally distributed, and two, it subscribes with how human beings think. Human beings think in two dimensions, risk and return. More advanced human beings start thinking about risk return and skewness and kurtosis, which Ralf might have mentioned in his first lecture. But most human beings just think about risk and return. Now, deep down inside your mind, you probably have some ideas about skewness and kurtosis, but on the face of it, just risk and return. So how we calculate this is as follows. We say equal to ln, and we'll take the second number divided by the first number. And we can do that across, so that means I've got the returns for all the 5 asset classes, and I can take it all the way down here. So now I have returns for every asset group: bank bills, corporate bonds, government bonds, ASX 200, A-REITs. And I can then look at some kind of statistics on this. Now, to work out the statistics, I'll go into data, and I need to have something over here which says, just in this panel over here, which says data analysis, and another one which may say solver. So we are going to look at just the data analysis at the moment. So for that, you have to go into files, you go into options, you go into add-ins, and it says analysis tool pack, you say go, and I'll just click the first one, which is the analysis tool pack, and the last one, which is the solver. And I go, okay. Now notice what happens. You notice these two things that just came about? So we're going to use the first one now and show you how this works. So we'll go into data analysis. And the first thing I want to do is just to understand the correlations between these assets. So I say, okay, input range. And then it says an output range. Okay, there you go. All right. Okay. Generally, when I look at these numbers, what I try to do is have it in just 2 decimal places. It's slightly easier for me. There you go. All right. So, based on this correlation, Alice and Lee, can you see from back there? No? How's this? How's this? Good? All right. So, Alison Lee, what can you say about from observing from this correlation table? What do you notice? So remember, this is bank bills. So this is cash. Yeah. This is corporate bonds, government bonds, ASX 200, and only the real estate. Right? And we know that this is a correlation matrix, so whatever you have over here is on the other side as well, correct? Okay. Now, what is the correlation between the fixed income securities, that means bank bill, corporate bonds, and government bonds? How are they correlated with each other? Positively or negatively? Positively, Lee? So bank bill positively correlated with corporate bonds, positively correlated with government bonds, yeah? And why do you think that's the case? Why are they positively correlated with each other? Because they're all affected by the same risk factors, which is the yield structure, term structure. Corporate bonds are less correlated with government bonds because you also have the corporate risk there, right? But more correlated with the government bonds, yeah? All right, good. Alice, what do you notice about the correlation between ASX 200 and real estate? What kind of correlation do we observe? Positive, negative, high, low. Pretty high, yeah? And why do you think they're high? Well, because they're both risky assets, yeah? So you have assets that have low risk or risk depending on term structure, and assets that are depending on economic conditions or how the economy is performing. So you have a high correlation over here. And what is the correlation, both of you girls now, what is the correlation between growth assets and defensive assets? What's the correlation between them? Pretty interesting, no? Go on, tell us. What do you observe? Positive or negative correlation between growth and defense? Negative. Growth and defense. Yeah? So over here you notice that there's a negative correlation over here. And that's exactly what we mentioned, that bonds are negatively correlated with equities. And what that tells you is that in one market condition, when one is doing well, the other one is not doing as well. Yeah? Notice that none of these correlations are really high. I mean, yes, we have a high correlation between government bonds and corporate bonds, and we have a high correlation between ASX 200 and real estate. But that is expected. Outside that, even that is not equal to 1. Notice that it's not 1. So you're still getting diversification benefits, not as high. Yeah? Questions, anybody? Now, the next thing I want to do is show you some other characteristics of these assets. So what I'm going to do is, I'm going to select this thing called descriptive statistics, yeah? And I'll say, okay. And again, it asks me for the input range, so I'll give it the input range. And then it asks me for an output range. So I'll give it an output range. Let's say somewhere over here. And out of these 4 boxes, it says summary statistics, confidence level for means, kth largest, kth smallest. These are just the percentiles, top and bottom. Which one do you want to select? So I just want you to select the first one, summary statistics. Yeah? So we select summary statistics over here, and I go OK. And I get all this. So I'm just going to clear out some of the crap over here. Oh, I should have done. Again, I'm just going to make it into 2 decimal places, maybe 3, just so that I can see them better. Now remember, this is all done on quarterly basis, yeah? The mean is telling you the average return, obviously. The next one is standard error. Ignore that for a while. Median, I'll just take it out because I don't think we're going to use it. Then we have median. Do you use median a lot? Have you used median for any purpose? What can median help to tell you? When is median useful?
House prices.
Yeah. I mean, you're giving the asset, but under what conditions do you use median over mean?
Where not normal.
Beautiful. That's the answer. When your distribution is not normal, that means you might have a long tail on one side and skewed. So that's when you use median. So in this case, all you need to do is observe whether your median and mean are close together or not. If they're close together, it behaves more normally, etc. We have standard deviation over here. And sample variance. I'm just going to take out the variance because it's of no use. We have skewness and kurtosis, and I'm just going to take out these range. I'm just going to leave it, sorry. All right, now, this data that I've got for you starts from 2005, and it carries on to 2006, well, end of 2016, beginning 2017. In this period, we saw a couple of different events. We saw building up of the real estate bubble, collapse of the real estate bubble, the global financial crisis in US and in Europe. There was a whole bunch of events that took place, so we have that. And then, after the global financial crisis, we see the recovery of the equity markets, all right? So we kind of have that. Now, so we covered a couple of cycles over here. What do you observe in terms of returns? We notice that the returns on equities is the highest risk. Notice that the risk over here is high, pretty high, 7.92% with a return of 1.8%. Keep in mind, these are quarterly, yeah? Government bonds, 1.38%, with a risk of 2.6%. So you notice that the risk over here is much smaller. And you notice that the risk is much, much smaller over here compared to these two guys. So these are, by definition, growth assets, not just because they have higher risk, but also higher returns. Over here, you notice that the returns are quite small. So 1.08, 1.6, 1.38, right? And the returns over here are quite low. In fact, it's even lower than bank bill. And there's a reason for this. In 2008, I can show you the numbers. In 2008, the GFC was happening over there. The real estate market collapsed in Australia. So if I show you some numbers, so take a look at these numbers. So here are A REITs, and I just want to focus over here. So these are quarterly returns, miss. Sorry, what was your name? Tia. Tia, these are quarterly returns. Take a look at that. Minus 13% in one quarter. Minus 20% in one quarter. Minus 20% in one quarter. So you notice what happened over here. This was a massive collapse that took place in Australia. And in your mind, it could be that, oh, did it happen because it started on from the US? Actually, we had our own problems. So it was, to some extent, imported from the US. But our other problems was that our own real estate investments were making investments in markets they didn't understand. They were highly leveraged. They were taking foreign currency loans, which, because of the global financial crisis, were quite cheap. So there were a whole bunch of issues that got affected over here. So this was a horrible period for Australian market. This, I mean, if you notice, this is a cumulative of about 60, 70%, really impacted those numbers.
So
Yes.
they didn't make enough with like recent housing price increases to make up for.
Okay, so the housing price increases in Australia is only limited to Sydney and Melbourne, is only limited to apartments. And that's where the influence is. Now, the real estate market is not just residential, it's also commercial, it's also leisure. So, when you start, one of the largest investments that we'll be making is in corporate office spaces and in leisure, so gaming in hotels, and then also in okay, something just went. Okay, I couldn't remember. Anyhow, so but the point I still want to make over here is, so small increase over here, then negative 43%. I mean, these were just brutal numbers. These were just absolutely brutal numbers. And these were because these were development REITs. So most of them suffered on development REITs. Oh, shopping malls. So Westfield, so something like Westfield. Yeah, that's what happens, brain kind of catches up after a while. All right. Now, when we create an asset allocation based on these numbers will be reflected. And the problem is these numbers are, what you see over here, is a reflection of what happened in the past. Right? So I can take chunks of period in every aspect and say, so similarly, we are looking at the global financial crisis, minus 24% return, so on and so forth. But this is not something that went across. This was something that, and you can notice that REITs, which are riskier than treasury bills, are giving returns lower than treasury bills. You can see that number. Highest risk over here, 10%, 11%. And the lowest return. So this is only the effect of those numbers. Now, suppose we have those numbers and we can't do anything about it. Can we then create an asset allocation? What I'm going to do is I'm going to use my asset allocation. Oh, no. Oh, come on, where did I put it? Sorry. I just want to figure out where I got this stuff. All right, there you go. Sorry. Just give me a couple of minutes. I should be with you guys in a bit. All right. So, actually, why should I do this? Sorry, I'm just going to not bother with messing around. What I'm going to do is just show you how to do this. So similar to what I did over there, I've got 5 asset classes over here. I know they're slightly different from what we were using, but it'll help me demonstrate the idea so I can use the real data later on today. I've got 5 asset classes: government, high yield, S&P 500, EAFE, and emerging markets. Actually, you'll get this data anyhow later on today, but I just want to show you. So these are government bonds. These are corporate bonds, high yield. S&P 500, the US equity market. EAFE is the developed markets, and emerging markets over here is EM. And we've got data over here from 93 down to what happened? We use this thing called a solver. And this solver is set up for 5 risky assets. These are the 5 risky assets I'm going to give you. And when we try to run a solver to create a portfolio for us, what we're going to do is we're going to create a portfolio return and portfolio risk. Now, I don't want to repeat what Ralf did last period, but I'm just going to show you what is expected. So what we want to do is we want to create portfolio returns and risk, standard deviation. So how do we work out portfolio returns? And the answer is, well, portfolio returns are pretty straightforward. This is a summation of how much you invest in each asset multiplied by returns on that asset. And how do we work out portfolio risk? Portfolio risk is as follows. I'm just going to write this long equation, or this equation, but it might make you feel that I'm putting down something very complicated. So it is something like this. I goes from 1 to n, j goes from 1 to n, wi, wj, covariance of I and j. So that's the equation of risk. It's a short equation. The equation is quite small, except when you start opening the summation signs. So let's say we are looking at 2 assets. So for 2 assets, how do we work out the returns? The return is going to be investment in asset 1, how much, multiplied by the return on that asset 1, plus investment in asset 2, multiplied by return on asset 2. And when I talk about risk, I want you to observe how these summation signs open up. So my n is equal to 2, right? So first time I is equal to 1 and j is equal to 1. So when that happens, I'll have I1 and J1 and covariance of 1 and 1, correct? Alice, you happy with that? So this is just when I is equal to 1 and j is equal to 1. Yeah? So this is I, this is j. So I1, J1, covariance of I and j, covariance of 1 and 1. Second one, I still remains 1, j becomes 2. So it'll become W1, W2, covariance of 1 and 2. Then I becomes 2, j becomes 1, so it's W2, W1, covariance of 2 and 1. And then both become 2, so it's W2, W2, covariance of 2 and 2. Now, this is just how these numbers are. When multiply W1 with W1, that becomes W1 squared. And the covariance of one asset with itself is its variance. So it becomes sigma 1 squared. This is W1, W2, covariance of 1 and 2. This is W2, W1, covariance of 2 and 1. And the last one is W2 squared, sigma 2 squared. These two, Lee, are exactly the same. W1, W2 covariance of 1 and 2, or W2, W1 covariance of 2, 1. They're the same thing. So I can just multiply 1 by 2. So what I have as a net is W1 squared, sigma 1 squared, plus W2 squared, sigma 2 squared, plus 2 W1, W2 covariance of 1 and 2. Yeah? This is just a two asset case. If I now go to a 3-asset case, what will happen? It's very straightforward. So for a 3-asset case, it becomes W1 squared, sigma 1 squared, plus W2 squared, sigma 2 squared, plus W3 squared, sigma 3 squared, plus 2 W1, W2 covariance of 1 and 2, plus 2 W1, W3 covariance of 1 and 3, plus 2 W2, W3 covariance of 2 and 3. Now, you may say that, oh, this is so complicated. The beauty is, we don't have to do it by hand. Rudy is happy with that. Alice, there's no point memorizing this equation. We don't have to do this by hand. So our lives are simplified by our equations. So in finance, or in this case, what we do is we use matrix algebra. Notice our matrix algebra is covered over here. So when I do the equation of this, over here what we're doing is we are multiplying the weights. So here are our weights, and we are multiplying it with our covariances, which are from the next page, and we are multiplying it so that we get this number. So regardless whether we have 2 assets or 100 assets, we can work out the variance very easily using this matrix algebra. So at this point in time, for your class, for your assignment, you don't have to go beyond 5 assets. And this whole template is set up for 5 assets. So you're just going to use it as it is. However, when you go to AFM, you will be looking at a larger number of assets. Oh, but it's easy because it's so simple. You'd be laughing. Now, when investors demand portfolios, they demand portfolios on the basis of a certain return objective, and they want to constrain their risk. So because we know how to write these equations, what we're going to do is we're going to say, what is our investment objective? So investment objective is return equals to, let's say, 8%. Then you say, well, what is my risk? And that is usually measured by standard deviation. We can change that. And the question is, how much risk do you want? Well, let's start with the idea we want the minimum amount of risk to achieve that. So what we're going to do is we're going to minimize this. Now notice that for each asset, we know three things about it. We know its return, we know its risk, and we know its correlation with other assets. All right, we know these 3 things. We know the returns. We use some method by calculating returns. We know the risk, and we know the correlation. And I'll just show you that we know all these things. So notice over here, we know the returns for every asset. I know it's based on historical, but at least we know something. We know the standard deviation of every asset, and we know the correlation of every asset with every other asset. So we know these 3 things. These are required for our calculations. And so that's what we do over here. So once this is done, we know that our return for portfolio is summation of weights multiplied by returns, and our risk for the portfolio, variance, is In this setup, notice for each asset I know the return, the risk, and the correlation. In this two equations, what are the unknowns? What do we not know? The weights. That's the only thing we don't know. We know everything else, right? For the return equation, we know the return of every asset. We don't know the weights. For risk, we know the covariance, because covariance and correlation are related, right? So, and we know the standard deviation, so we can work out the covariance. We know everything except for the weights. Now, what that means is that wouldn't it be beautiful if we could have, Alex, so think about this, think about the beauty of this, that we can throw into a program all this data and say, tell us how much should we invest on all these so I can get a return of 8% and my risk is minimized. Now, from this class, how many of, does anybody have a computer science or interest in programming background? Not into? Nobody's into programming? You like watching movies? Playing games? Okay, that was just a question, because I was thinking, how come you're not interested? I thought most kids at this age would be interested in programming. No, but don't you do Visual Basic or C++? You do that?
I did it in engineering.
Oh, there you go. There you go. You probably have done more than that in engineering. You probably used, sorry, what did you use?
I did C.
Ah, you did C. Wow.
So
Dude, that's C. If you don't C, that's going back my time. So my undergrad is in computer sciences, and one of the first programs we is C, because it's such a beautiful language. So if you people think about this process, what's happening? What this software is going to do is going to play with different weights, and you keep on changing the weights, seeing which one will achieve this with a minimum of 8 risk. That's all it's doing. It's just doing some kind of trial and error by changing the weights, approaching the minimum risk portfolio. So at the end of the day, it'll have a whole bunch of portfolios that give 8% return. It'll then give the results for the one that has the lowest. I mean, this is just a simplified version of what's happening. So that's exactly what we're going to do now. Now, before we can start over here, we need to look at a couple of things. Now, I'm not going to discuss what these mu, alpha, sigma are. All you need to know is that this is the return for every asset class on an annual basis. That's all you need to know at this point in time. So we know that government bonds have the lowest returns, and so that's about 0.25%. Then you have 1.21% for high yields. Then you have 10% for S&P 500, 6% for EAFE, and 10% for emerging markets. This is just the returns. So if I know that the lowest return I can get is 0.25%, and the highest returning asset is 10.32%, can I, as an investor, ask for a portfolio that gives me 15% return? Why not?
Because the highest return is 10.3.
Exactly. Suppose I relax the law rule that you don't just buy, you can also sell. You can also short sell. Can you get more than 10%? And that's the idea of leveraging, all right? So when we have a restriction that you cannot short sell, Miss, what's your name? Vanessa. Vanessa says that the highest returning asset is 10.32%, so the highest returning portfolio will be if I put 100% in this asset. Correct? So the highest returning asset is 10.32, and if we put 100% of our investment in this, the return should be 10.32. We cannot get higher than that. I'll show you how you can generate higher returns by leveraging, by short selling something, but also tell you that it's also risky. What's the lowest return? 0.25%. Our return objective that we want is 8%, right? So what we do is, in the target cell over here, we say we want a return of 0.08. And we try to run this solver. So for solver, you go into data, pick up solver. Sorry, these are other things that I did, and I'm just going to get rid of them. All right. So I know Alice is too small to see from there. Do you want to come up? Or no, you're happy, or you can see it again during the recording. All right, cool. So I'll just keep on talking about it. Alice, so this lecture is now just dedicated to you and Lee, because you can't see from there. Tristan, you can see, right? How about you, sir? You can see? Wow, but you have, okay. No, so am I. And Tristan has his glasses on his head. He doesn't even care about the glasses. He's like, cool. So we are going to make sure that we do a couple of things. First thing is that we're going to say that all our investment have to add up to 100%. That's our necessary condition. And we put that over here. So this says sum of weights is equal to 1. And we put that as a condition over here. So notice this line. This is 14. Yeah? So we say $H $14, which is $H $14, is equal to $J $14. That means the weights have to add up to 1. That's our first condition. Our second condition is each asset has to have a weighting more than equal to 0. So you can go as low as 0, as high as 100%. Actually, we don't mention it specifically, but that's supposed to be there. And our third condition is that our portfolio return should be equal to 8%. So these are our three conditions. And then we run this software. So what we're going to do is we say solve. It says, yes, I found a solution. And the solution is, for 8% return, you have 20% in government bonds and 80% in S&P 500. And that gives you a portfolio that gives a return of 8% with a risk of 12.09%. So what this program has done is generated an allocation, whether you like it or not. And we discussed this after the break, why we don't like this allocation, what's wrong with it, why did we get such an allocation. At this stage, all you're saying is that this software can generate an asset allocation if you give it a couple of things. You give it its return for every asset, you give the risk for every asset, and you give it a correlation. Once you do that, it can generate an allocation for you. Till break, till 2 minutes from now, that's all I want you to understand. After the break, we get into more details. All right? Any questions at this stage? Or is everybody starving? Where are you guys going to go for food? Please don't say Chibo. All right. Have a wonderful break, and when you come back, and if you have an ability, if your house is nearby, like yours, hopefully you can get a laptop. If not, that's okay. Everything is being recorded. Thank you so much. I'll see you after the break. Oh, yeah, sorry. When are we breaking to? So at the moment it's 11:45. We come back at 1:45. Yeah, so 1 hour. And my understanding is the class goes up till 4. No. My understanding is 4 o'clock. I'm so happy to be here till 4. Maybe I'm going to be here on my own. But yeah, my objective is to at least 3:30. And then after that, a couple of more minutes for people who need to ask questions. All right? But we'll be done by 3:30. All right? Have a great break, and I'll see you later.
So for the allocation, we're going to use the software, right?
Yeah.
We're not going to calculate with the Lagrange and something like that.
Sorry?
We're not going to calculate it manually, like using Lagrange.
No, 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 no. No.
Because it's kind of sorts of.
I know. No, no, don't worry about that.
Thank you.
No worries, buddy. Rudy, kapan datang di sini? Qantas. November kemarin. Baru? Oh, bagaimana di sini? Pertama kali?
Ya, pertama kali ke Australia langsung ke Adelaide.
Enak? Sepi ya? Di Indonesia tinggal di mana? Jakarta?
Di Jakarta, di Lebak Bulus.
Di
Selatan.
Hi, thank you so much for coming back. Hopefully you're energized after your meal and maybe some coffees as well. What I've given you is two documents. The first document, a single pager, is your assignment sheet. This assignment sheet is it's a simple assignment, and we can increase the level of complexity in case you're keen to. So remember, this program, this course, is actually targeted towards students who are just enrolled in the first set of core subjects, or not even there. So for people who have done the basic courses. However, I understand that there are a lot of students in this class who are at a more advanced level. And in case you want to have an advanced assignment, I'll be very happy to go in that direction. Well, I'm just saying, in case you're interested. However, on its own, this assignment is quite complex. First up, this assignment requires 3 people in a group. My understanding is there are 22 people in the class, so there will be one group that will be of, oh, should I start again? No, that's all right. So as I mentioned, this assignment is groups of 3. There are 22 people in this class. There'll be one group that is of groups of 4. So whoever comes to me first saying that you want to be in a group of 4 with 4 names on a piece of paper, that will be the group. All right? Otherwise, everything else is a group of 3.
Or maybe someone can do it individually.
You want to do individually?
Yeah, I'll do it.
All right. All right. You do realize it's a lot of work.
I know that, but it's I'll rather do it individually because of the that other plans.
Oh, more plans. Actually, if you are not involved in many other courses, you can do it individually. It's not too difficult. In fact, in my mind, this assignment is quite fun. Oh, hello. Hi. Don't worry about it. The red bit. So, if you take a look at the assignment, this assignment requires there's an asset allocation that is already created for you, and what you are supposed to do in this assignment is 3 phases of it. Sorry, can I? All right, thanks. So I've mentioned that there are 3 different sessions in table 3. These sessions have a slightly different investment objective. So table 3, Rudy, on the other side. Yeah, just the bottom.
Yep.
Yeah. So those are the 3 sessions, and again, you have to volunteer for a session if you want to. I've given a kind of a presentation schedule. So there are 3 slots over the day. This is on the 27th of May, right? The 3 slots. Slot 1 is, session 1 is for one investment objective. Slot 2 is for another investment objective, and slot 3 is for the third investment objective. You can choose, discussing within your group, which session you want to present in, depending on which investment objective you prefer. If you go to table 2 above, it shows you the asset implementation constraints. It talks about what kind of fund you are able to select for each asset class and how many different fund managers. Very similar to the idea that I showed earlier on. Remember the IPS? There was that no more than 15% in the group. It's a very similar idea. So we are hoping that you will be able to, as John mentioned, diversify fund manager risk within asset class, or as somebody else mentioned, to focus on a segment in an asset class. So we'll talk about that. So what do you need to do in this assignment? Observe that an asset allocation is given. That asset allocation may or may not be relevant to the investment objective. And that means you have to recreate or refine that asset allocation. Somebody might say, oh, look, Aku, I think this asset allocation is perfect. It works really well. Somebody else might say, oh, no, I think it doesn't work well. And there could be many different ways that you can show me that. One of the easiest way to show that this asset allocation will or will not work is by looking on historical basis that does it achieve its investment objectives. That's the simplest way. The other way is creating a optimized asset allocation using the solver and saying, well, this asset allocation is different from the one I got. Of course, there are problems with everything, and we'll discuss those problems. However, that's the idea. Finally, you have to find funds from the market, only the Australian market, so you cannot go outside the Australian market, to implement this asset allocation. And that is where the second handout comes in handy. So the second handout is simply about implementation of this asset allocation. For example, let's say we go with the idea that you are going to invest, how much in fixed income? 20%. Suppose it says that you are going to invest 20% in fixed income securities. You don't want to, you did not change that asset allocation. So the question is that how will you find a fund manager for this? What kind of fund manager are you going to find? How are you going to look for it? Will it be an active fund manager, a passive fund manager? And notice that I've kind of indicated that you have to consider a time frame in the future. So you need to be focused on that. For example, you need to have some relevant understanding of the global economic situation. You cannot work on this assignment without understanding the global market situation. So what that means is that you first have to understand what the investor wants, and then you have to understand what the capital market is able to provide. You cannot have an investor who wants more than what the capital market provides without affecting the risk profile. All right? So we have to be very careful on that. So in the implementation, I've provided how you're going to select the funds. And of course, in the first day of your session, the day one, you've already gone through various performance measures, and I'll talk about those. Not all performance measures. For example, you also went through trainer's ratio. I will not use trainer's ratio. You also went through information ratio. I will not use information ratio. So I've just mentioned 3 performance measures in your handouts, and when we go through the handouts, you'll see them. There's only the tracking error, which you know very well. You also understand abnormal returns alpha and Sharpe ratio. So these are the only 3 ratios that we'll consider as far as this course is concerned. All right, back to our analysis that we were kind of working on. So I'll go into data. I still have my solver. All right. All right, so this is where we stopped. We kind of ran this solver, and we got a certain asset allocation. Now, ladies and gentlemen, if I could get your input as to what is wrong with this asset allocation, what could be your potential answers? What's wrong with this asset allocation?
It's not not diversified.
It's not diversified. It's involved in only 2 assets. And both of these assets are from the same market. US government bonds, US equities. Can I ask you a question? Why would you like to see diversification? What would you like to see over here? In terms of diversification, you want to see assets in different asset groups, right? But why would you want to see that?
Minimize the risk.
As you diversify, and the idea of diversification is that there are 2 assets that are not perfectly correlated. The moment the correlation is less than perfect, you can reduce the risk by investing in both of them, right? And we can see that from the names, here is a developed market, EAFE. Sorry, it doesn't show up very nicely, so I'll just open up these. There you go. Much better, yeah? So here is EAFE. EAFE is developed markets outside the north of America. So it includes Europe, it includes Far East, it includes Australasia. And here is emerging markets. Emerging markets consist of mainly the 4 BRIC nations, Brazil, Russia, India, and China, and of course South Africa and Indonesia are the larger emerging markets. And emerging markets are essentially markets that are trying to become developed by improving their regulations, improving the markets, how efficiently the markets work. Notice something very important. Higher market regulation or better market regulation results in higher capitalization. More investment takes place for the public. And this is a very important connection. So when you said, when we were talking about large capitalization and you said China, in terms of market economy, China is almost the #1 economy in the world. But in terms of capitalization, they are not the largest, not even the 2nd largest, not even the 5th largest. And the reason is because the regulations are still not there. As soon as regulations come in, what it does is it provides investor protection. The problem at the moment is that when investors invest in a market, if they're not 100% confident that their money is safe, they are not going to invest. Simple as that. It's not a finance concept, it's a logical concept. That if I feel insecure in a market, I will not be there. And so what most emerging markets do is that they try to invest not just in their own economy, but move a lot of capital into developed economies. Anyhow, so what's your name? Rakib. As Rakib mentioned, we don't have diversification over here. Now, here is the more difficult question. Why not? Why not? I know you know, but I'll give you the chance to go last. Why not? We just saw that diversification provides lower risk, and our objective is to minimize this risk. So why did I not get allocation in these 3 to get a lower risk portfolio? Remember, this is a simple program. You give it equations, it'll try to solve it the best it can. That's all it does. It's not thinking. It doesn't understand what Rakib said, diversification, oh, I invest in different markets. It's not interested in that. You've given it a risk equation, a returns equation. It tries to achieve this by minimizing this. How does it minimize this? By playing with these weights. And when it gets the weight which gives the lowest risk, it selects that. That's it. No thoughts. So why is it that we are not getting a diversified portfolio? What's wrong with our numbers? Take a look at this. To be allocated to any of these asset classes, you need one of 3 things. Either your asset has to have a very high return, and it should come with a lower risk, and the correlation has to be low. So if I can get all 3 things, I should have allocation to that asset. So take a look at equities. Equities has the 2nd highest return. Yeah? In terms of its risk is sitting as the 3rd highest. 2nd highest return, 3rd highest risk. So that shows it that its returns are higher than its risk amongst the 5 assets. Take a look at its correlations. It has low correlation, in fact, negative correlation with government bonds, less than some correlation with high yields. And then, I mean, the correlation doesn't go up more than 0.7. So you notice that this asset, when included in the portfolio, provides higher return, lower risk, and also provides diversification. Let's go with the highest returning asset, emerging markets. Emerging markets come with 10.32% return, higher than this by about 30 basis, yeah? But in terms of risk, it's almost 60% higher. So to include EM in this allocation, we know that the returns are high, but the risk is very high. What could get it in would be if my correlations over here would be low. But what you notice is correlations are quite high. 75%, 71%, 62%. The only correlation it has low against is with government bonds, but then government bonds has low correlation with everything else. So you're not getting that in there. All right. Similarly with developed markets, this is very easy for you to understand now. It's almost the third lowest risk returning asset, much lower than this. Its risk is higher than equities, domestic equities. And again, in terms of correlation, you get some benefit, but not a lot. So you can understand why you're not getting those allocations. How do we rectify this? How do we rectify the solution, this issue? So let's go back and ask, why did this issue take place? All right, before I go on, about 9 minutes to go, before the recording stops. So I'll just have to re-record again. All right, so why did this happen? What do you think? Yes, sir.
Is that because you didn't set any minimums for like what it had to? So for the examples we've been given, you've said like, you know, a minimum of 10% in this, a minimum of 5% in this, but for that you've just gone, give the best solution possible.
Good. So that's one. And what you're trying to do is now forcibly allocate. But I'm asking a question prior to that. That will sort out the issue, and I'm so glad you mentioned it. But prior to that, why is it happening? I mean, Raqib is quite right. The more assets you invest in with different correlation or low correlation, I should get diversification benefits. And here's another thing that all of you must understand. The markets are efficient. No matter what people tell you, markets are quite efficient. Investors are smart. They will invest in something that gives you higher return for lower level of risk. It's an obvious thing. Everybody will do that. So if that is the case, how can an asset like this exist, where the returns are so low, but the risk is so high? How can it exist? Investors should go away from this asset. As investors go away from this asset price falls. As asset price falls, it means the next return will be higher. So by definition, this is a temporary phase. This is something that you observe because of the data you've chosen. And in this data segment that you chose, developed markets did really badly. If I'd chosen a different data, perhaps I would have gotten different returns and results. So what I'm trying to show you is this, that because this is based on historical data, I'm only capturing what the data has shown. If in that data, one market has only gone down, chances are you'll get horrible numbers over there, return will be low, risk will be high, and of course it will not get allocated to anything. So it is all data dependent. What can we do about this? There are a couple of things that we can do. The first thing is, and we'll come to your point later on, this discussion is simply based on how we can improve this without forcing allocation. So what you were doing was essentially forcing allocation, and we might have to do that over here. But prior to that, suppose we were able to forecast. Our question is going to be, can I change these numbers? Can I change these numbers? Because remember, these are our expectations. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So let's change these numbers and think what is going to happen in the US economy and globally if I change these numbers. So in the next 1 year. So, what I want you to do is make projections. I know what I'm asking you to do is at the spur of the moment, but I'm not going to be, oh, look, you said 7%, it should be 7.2%. No, I just want your opinions, all right? We understand how many of you guys have an understanding of how the market is going to flow on in the next 1 year? What do you guys think is going to happen? I want your opinions. Generally. Sir?
Okay, I think that if you look at start with the U.S. equities.
Who took my Coke? Did you take my? Oh, okay. Sorry.
I will start with the equities in U.S. Okay, I think it's.
No. I'm not talking about equities. I'm just saying economic climate. How do you see the economic climate? Positive, negative, same?
It depends. I think it's gonna continue positive in the U.S. Okay, Donald Trump just taken over, and he's planning to smooth the fiscal policy in order to offset the tighter monetary policy by Janet Yellen. Okay, eventually this is going to have positive impact on the economy, but we can also ignore what's happening in the equity markets. We are very expensive.
No. I'm not interested in the equity market. I'm just interested in economic forecast.
Okay.
Positive, negative, same.
I'm positive in U.S. Okay, it's when it comes to other markets like Australia, maybe GCC, it's countries that are more of like commodity based. Okay, dependent more on resources. I think it's. I'm also positive because I believe that we are going to see a more of like recovery in the commodities prices. Hopefully that the US dollar will depreciate a little bit.
You're mixing up so many ideas. I had a very simple. I just wanted to get a feel as to how you see the market moving forward.
I think we're going in the right direction.
Positive.
Yeah, positive, yeah.
Anybody else with something more, John?
I'm negative, but I'm a bit of a pessimist.
Look, the bear hunters, the bears always exist, and that's all right. Go on, tell me.
I just think you look at a lot of places in the world and you're seeing increasing uncertainty, political and economic. And as well, you're getting a lot of, in my opinion, you look at a lot of the US, especially large caps, and in Australia certainly, and you're seeing a lot of overpriced stocks.
Very similar to what this gentleman just. Oh, what's your name, sir? Hussein. So what Hussein just mentioned. All right, cool.
Yeah.
But Hussein is kind of positive about the U.S. market. You're not so positive.
By the way, actually, there is, that there could be a mismatch between the performing of the economy and the performing of the stock market.
Oh yeah, of course.
Back in 2009, 2010, the market was flying, but the economy was.
Oh no, we understand that there's a stock market is forward-looking. No, I'm just interested in the economy.
Yeah, the economy as a whole, I think.
Rakib, what do you reckon? Positive, negative?
I think positive.
All right, cool. New Trump is your savior?
I'm a little bit pessimist, but...
Trump is pessimist. I thought you'd be optimistic about Trump.
I think because he's Muslim.
All right, the non-Muslims speak up now. Tia, what do you reckon?
Maybe positive.
Positive because? Globally or just US you're talking about?
Global.
Global? Are you asking me or are you telling me? Global. Louis, what do you reckon? Negative. Oh wow, cool. Why? I like people who say the opposite. Tell me why.
Maybe just so many promises that Trump gave.
Okay. He's a liar. Of course.
Doesn't convince, so.
Yeah, because he was saying so many things. He was going to repeal Obamacare, he was going to lower taxes, he was going to build bridges. How can you do everything? It just doesn't seem right, yeah?
Just failed to do Obamacare repeal as well.
that happened overnight, yeah. It was just a terrible thing. Alex, you're getting bored. What do you reckon, buddy? Oh, no, so not Alex. Sorry, what's your name, sir? Louis. Oh, of course. Louis, I'll call you Coke Louis because, to just differentiate. So, Coke Louis, what do you reckon? Positive? All right. Now, what I want you guys to do is for the 5 asset classes within your table, I want you to come up with a consensus expectation return for the next 1 year. All you need to do is put down the numbers with some brief argument, discussion within yourself. Yeah? So we have 2, 4, 6 over there, 2, 4, 5 over there, 2, 4, 6 over here, 5 over here. Good. I have 4 teams which are kind of equal weighted. Sorry, when I say equal weighted, I mean in terms of people.
What are supposed to do now?
What you're supposed to do is come up with new numbers for each one of these assets.
Okay, hypothetical numbers.
Well, not hypothetical. I mean, not random.
Yeah.
Something that you all believe that is going to happen for the next 1 year. So I know consensus is the. It's not with economists, econometricians and professions in the field of economics. There's never any consensus. Everybody will argue and everybody will have their own thoughts. I understand, but there'll be some people who'll have a bigger voice and a stronger voice, and they'll probably dictate what happens. I don't care. I just want to know what numbers you come up with for all 5 assets. So just on a piece of paper, in your group, on your table, come up with the number.
Risk return correlation.
I just want the first one, returns.
Okay, the
The only thing. So government bonds, high yield bonds, these are corporate bonds with a lower credit rating, S&P 500, developed markets, emerging markets. I just want your opinions on this.
What do you guys?
Talk to John.